First of all, thank you for tuning in once again on our Monday weekly research call. This time I'll be doing it a bit different. We'll be doing a summarized version of the strategy and stock pick for the third quarter 2021. So we'll do a summarization. So first of all, I will just go first on the technical view. So first up, the Straits Times Index has already the weekly chart, based on weekly chart, and the one that's shared 2 weeks before. There's two scenarios that I'm pointing out. There is that if there's a breakout above resistance zone 1 immediately, then there will be a pattern in the formation. Okay. Another thing is which another scenario which I'm more tilted to is where there's a correction down to support zone 2, where you will be forming a bullish flag going on forward. So for the first target price will be at 3,345, and then it will be by end of third quarter. Second target price will be 3,410 by end of 2021. So in either way, I don't foresee a very strong downside unless support zone 2 is broken. So either way, either a correction, rebound to target 3410, or straight away a pattern that's going to target it further. All right, so for the STI index, right, this is a daily chart. This was prepared based on last Friday close, so I don't the chart shown over here do not have the update of the what was it called, the price pattern. Okay, so but based on the chart that I'm seeing, right, the live chart, I'm seeing there's a gap up, and then there's a bearish sell down as of today. So currently, I think this immediate resistance zone at 3,002 region will be highly resisted, and then come off a selling that will bounce off a support zone 1 and support zone 2 going forward. All right. Also, it is kind of like a range right now ever since it break out of the immediate uptrend line. Okay, so next one is you have heard me talk about nanofilm technologies quite a number of times. Okay, but price did have a continuous sell down despite this dark cloud cover not being completed. All right, but nonetheless, I think this resistance zone 1 will likely be the new support zone. All right, that will rebound and then target the target resistance zone 2 at $6 to $6.41, which is my target price 1 by end of third quarter. Target price 2 will be at $7, which is way beyond 161.8% of this sub wave, which is a third wave target. Okay, so this is my target. But whether this third wave is likely to complete, I think it is, because it has already broken the wave 1 top. It's just that price shouldn't just close below here. All right, or this may be a bull trap, which I'm quite afraid of. All right, nonetheless, I'm still looking forward as a bullish counter. All right, so CapitaLand weekly chart. I believe that short-term wise, we can see that this resistance zone 1 is going to break. It's going to target 4.38 level to 4.45 level in the midterm. All right, so reason why is because I think this resistance zone has been weakened, has been tested multiple times in over close to a decade. All right, despite there's a huge gap up, and then before a sell down, it rebounded from the support zone and with a short-term golden cross over here. Price is likely to go up on the upside once again. All right. So long-term target 4.45% or $7.20. 50% retracement target is likely to be hit. All right. Okay. So next one is the daily chart. So daily chart, it shows today as it opened for business today, trading business for today for CapitaLand. Price continued the bullish engulfing, not a very strong bull, but it's right now within the resistance zone over here. So likely I foresee if it's not going to close to a strong one, likely I'm going to see a slight pullback before a breakup above for CapitaLand. All right, next one will be Del Monte Pacific. Okay, so I didn't do a very full alert wave count, but you can see that this is a extended wave three. We have 1, 2, 3, 4, 5 completed. So wave three, we are looking now at the wave four. Theoretically means that it's a very good chance to buy a correction. So where's the good accumulation point? It will be at support zone one and support zone two highlighted. All right. So with that, I end off my presentation. I'll pass my time to Paul for the Phillip on the ground for Del Monte. All right, Paul, to you.
Yeah, thanks, Viren. So we wanted to do something different. We just wanted to complement his technical views with whatever fundamental overlay that we can. So for Del Monte, this is just a brief highlight. We have no coverage, but the outlook looks promising. There are several reasons for this. So Del Monte is mainly in US and Philippines. So for the US, they made an acquisition in 2014, and it took them some time. It's almost 6-7 years to turn around this company, and we've started to see the turnaround. But the turnaround has come from closing factories, new product innovations, penetrating food service. Now these are like your fast food chains or QSRs, we call them. And what they've also done was to exit from private label and government tenders. So these are very low margin because the prior management was focused more on the pet business, and they sold out the US business, which is essentially more on canned vegetables. If you see the picture on the left, the top, a bit blurred, sorry, but it's like canned beans and so forth. And the other thing is they also raised prices in May this year. So this should help in the turnaround for the US. The other positive is Philippines. We initially thought that Philippines was already very well penetrated since they've been there for decades, but they still have room to grow with expansion of their distribution points. So they have about 90,000 going to 200,000, and who leads the distribution is actually the multinationals like Unilever and P&G. Another driver would be their new dairy business, which you can see the picture called Mr. Milk at the bottom right. Another driver to the recovery would be China. So what they sell is pineapples, and pineapples is high margin since there's no processing, and they will continue to expand their distribution. Finally, the next driver we think would be the listing of Philippines, their Philippines business, which could be in the high because most of the consumers in Philippines trade like 20 times plus, and the motives are 14 times. So the main thing is, of course, a bit of re-rating, but also secondary will be they will raise money and they can help wind down their preference shares, which is dilutive. It takes out about 20 plus million from the earnings per share, and also continue to help reduce their interest expense, which is another possible driver to the share price as the profits return and cash flows improve. Okay, so that's it for me on this. I think next slide. Okay, we go on to our stock picks. This is just a summarized version of the presentation. I think the full version will be in YouTube, but it's quite long, it's about 2 hours. So I'll just go through our absolute 10, our model portfolio for the third quarter. The additions we did was we put in Ascendas to replace Manulife, which Natalie can explain later. And then we also removed Protnex purely because of the outperformance. The share prices did very well, I think about almost 60% in second quarter. And then we replaced it with DBS, I think which Terence will help out to explain. In terms of the performance, you can see the table on the right. It would be our monthly. Again, this is just for transparency and accountability of the calls and of what we like the most. And so you can see that we were still trying to recover from the Yoma, the inclusion of Yoma. So that took a hit in February and March. So hopefully with the coming months, we can kind of recover and get a better performance. That's the year to date is for. And just a reminder, so in the second quarter, we had two very strong stocks, which is Propnex 50% and Q&M almost 24%. You can see from the table. But even then, for the quarter, we're only up 8. So every quarter we have a summary of how we perform. So last quarter was so bad that you should let the dogs out on us. But for this quarter, we just want to remind that shouting a strong performance of one or two stocks, which some funds like to do on the media, doesn't really help the portfolio. So ultimately, a portfolio, you need everyone to perform. So even though we did well in one or two names, but we were dragged down by, you can see from here, like Thai Breath was a big drag, Comfort was a big drag. Thai Breath normally because of the resurgence of COVID cases in Vietnam and Thailand. Okay, so this is just our illustration. This is our model for third quarter. I think we can move on to the details of some of the topics. Natalie, over to you. Thanks.
Thank you, Paul. Good morning, everyone. So just starting off with CapitaLand. Okay, so for CapitaLand, we like CapitaLand because of their growing and recurring revenue. They have a stable portfolio from their diversification into different asset classes, such as your retail, office, industrial, hospitality, and not to mention their development pipeline. Okay, so their recurring revenue actually comes from 3 different segments. First of all, their fees from their REITs and the private fund, where they collect management fees for the management of the assets. Okay, and of course, this is tagged to the amount of AUM that they have. So as AUM grows, these fees from the management of REITs and private fund will grow as well. If you look to the chart on the left-hand side, CapitaLand has been growing their AUM. Okay, and currently we are about 80K, and they have 80 billion, and they have a 10 billion 2024 target. Okay, so that should help to grow the stable recurring fee income, as well as fees from the lodging platform. So this lodging platform is their Ascott Limited, which is a privately owned, wholly owned hospitality operator platform. So they charge fees for, of course, the management of the assets, as well as franchising fees. So that, of course, is also tagged to the number of keys under management. So as they grow the number of keys under management, they also will grow their fees. So the last form of recurring income is the rental income. So this is from the ownership of certain investment property on their books, such as your malls, like your Ion, as well as your retail, your office kind of properties. Okay, so this will provide a recurring monthly rental income. CapitaLand also has a 3 billion asset recycling target, so they are able to unlock value from divesting, some of your more mature assets. So they did the most recent acquisition divestment that they did was the 2 Japanese malls located in Greater Tokyo, and they divested the 2 malls for about 500 million Singapore dollars and unlocked 100 million in capital gains. Yeah, so that's, of course, a very positive thing for CapitaLand as they try to become more asset-light and capital efficient. Last of all, the demerger will provide an opportunity to re-rate CapitaLand on higher valuations, or rather re-rate the fee and rental-based income portion of their operations on higher valuation. Okay, that's all for CapitaLand. We maintain our buy call target price of $4.38. Now moving on to Ascott. So for Ascott, we like them for their diversification by lease type as well as by geography. By lease type, they actually have 3 different lease types. If you look at the pie charts on the left-hand side, they are the master lease, MCMGI as well, which forms up the stable income portion of the revenue, as well as the management contract, which is the more variable and the growth kind of revenue. Because these management contracts, they are based on how well the property performs, based on occupancy as well as on average room rates. Okay, so Ascott actually aims to have a 50-50% split between the stable and the growth income. However, as you see in FY20, we saw that the stable leases actually help to mitigate the impact from the tourism volatility. So for FY20, the master leases and the MCMGI actually accounted for about 2/3 of the revenue, gross profit breakdown. However, if you move into FY21, where we see the recovery in the growth income, then we see that management contracts actually should account for more than 55% of the gross profit breakdown. Okay. And in terms of geography, Ascott has 8 key geographies. They are France, Australia, Japan, US, Singapore, and UK. Yep. So these are some of the key geographies. And because of their exposure to so many countries, 69% of the assets are located in countries with large domestic markets. So as we see the economy reopen and as travel lanes start to reopen, we expect that the domestic tourism is the one that will pick up first. Yes. Okay. And so because of Ascott's exposure to these countries with large domestic markets, we expect a potentially faster recovery than their peers. They are also listed on the SGX, which are more Singapore focused. In terms of growing the amount of stable revenues, Ascott aims to double the long stay portfolio of PBSAs, which stands for purpose-built student accommodations, as well as rental housing, to 15%. So when we started a year, it was about 7%, and they also picked up 2 more Japanese rental housing assets and a 45% stake in a student accommodation that is still undergoing development. So that helped to increase the amount of long stay assets in their portfolio to about 10%. Okay, so right now, the reason these two type of asset classes are deemed a very stable kind of assets, first of all, they maintain very high occupancy even throughout the pandemic. They maintain occupancies of above 95%. Yeah, and they also have a very a longer average length of stay of more than 1 year. So that provides income visibility and stability. Ascott is also able to divest some of their assets at above book value. This asset recycling, they have done several over the years, and they've exited assets at very tight yields of about 2%, and then reinvested these proceeds into higher yielding assets of between 4 to 6.5%. Yeah, and not to mention these capital gains, they can actually be shared with the unit holders and used to shore up the dividends, the DPUs. The last point, of course, very quickly, is the sponsor support. So their sponsor is the Ascott Limited, a wholly owned subsidiary of CapitaLand. So as the Ascott Limited supports Ascott Residence Trust in 2 ways. First of all, whenever should there be any asset that is facing any cash flow issues or issues with the tenant, the Ascott Limited can always step in very quickly to take over the operations to ensure that there is no downtime. We saw this, last year, WBF, which is a Japan business hotel operator, and also a tenant of Ascott Residence Trust, they were undergoing some liquidation proceedings. And so, of course, if there should be any need for handing over of operations, then the sponsor is always there to support, as well as in terms of the Ascott Limited growing the number of keys under management. So as they grow their brand presence and the number of keys, Ascott also will get to benefit from it, because a lot of their assets are actually branded under the Ascott brand. So they are the Ascott, Citadines, Somerset, and even Liv. Okay, so with that, we conclude and say that we have a target price of about $1.17, and we maintain our accumulate call. So this gives Ascott a FY21 yield of 4.2%. Now moving on. Our next counter is Ascendas REIT. So Ascendas, if you look at the pie charts over here, they are located in Singapore, which is their dominant, their largest geography, and of course Europe, United States, and Australia. In terms of asset breakdown, they own some business spaces, such as your business park, as well as your suburban offices located overseas in Australia, data centers, logistic assets, as well as industrial assets. So because of the kind of assets that they hold, they're able to capture demand from new economy sectors, such as your tech, your biomedical, precision engineering, the life sciences, and even your warehouse and logistics, e-commerce kind of players. Okay. So we like them because they are sort of like the beneficiaries of or rather the more future protected kind of asset class. Because of Ascendas REIT's scale and diversification, they have about 130 So 1,460 tenants in their portfolio. So that actually means that the largest tenant only accounts for about 3.8% of the revenue. Similarly, because they own 209 assets, the largest asset only accounts for about 4% of revenue. So this scale and diversification reduces the impact from any asset or any downsizing, non-renewal in any particular asset. So that helps to maintain a more stable portfolio. And Ascendas is one of the largest, one of the most active portfolio managers. So year to date, they've actually conducted about 338 million worth of asset enhancement and redevelopments. So some of these asset enhancements include, modernizing or refreshing the lobbies, the common areas of some of their business parks so as to remain competitive, as well as the more significant redevelopments, which include the UBIX, the 2 assets located in Ubi, where they actually reposition 2 light industrial assets to high spec assets. Yeah, so that allows them to, of course, command a higher rental income, as well as future-proof their portfolio, because tech and high tech assets are like the way to go. In terms of acquisition, they have conducted about 1,700 million worth of asset enhancements, acquisitions in year to date. This includes their portfolio of data centers, European data centers, as well as the most recent acquisition of the 75% stake in Galaxis from their sponsor CapitaLand. We are forecasting a forward yield of about 5.5% for Ascendas REIT, and we maintain our buy call and target price of $3.65 for Ascendas. Moving on to Keppel DC. Fraser Centrepoint Trust. So for Fraser Centrepoint Trust, I think needs no introduction, but because of their portfolio of suburban retail malls, and we believe that their portfolio is relatively resilient. First of all, we look at the graph on the left-hand side. FCT's proximity to households and the necessity-driven spending has actually led them to sustain an above-market recovery. As you can see, the red line, which represents FCT's tenant sales, is currently outperforming the RSI, which is the Retail Sales Index. Okay, so because they are located in the suburbs, the heartlands, 54% of their GRI is actually from tenants who are in the essential services sectors or trades, such as your F&B, your groceries, pharmacies, as well as some of the ancillary kind of service provider like your hairdressers, your nail parlors. Okay, and we expect the demand for suburban malls to remain strong, and we expect the larger and dominant malls to be prioritized amidst, consolidation or even expansions. These tenants would like to be located, in a well-located mall, which is like less than 5 minutes away from your transportation nodes, your MRT stations. Yeah, so we believe that overall, suburban malls will remain, the space in suburban malls will remain strong. FCT also stands to benefit from the increase in catchment size, which will lift tenant sales. So this increase in catchment size actually comes from, a larger daytime population due to the permanent hybrid work arrangements, as well as a 67% growth in the number of HDB units in the north area surrounding their Causeway Point, North Point, and Waterway Point malls. So as the number of BTO flats, of course, increase and come online, then we are expecting a growth in the catchment size, where these new household units will, then do their groceries in the nearby malls. The last part, of course, is the Singapore's effort to decentralize their commercial activities to the heartland areas. So that will also benefit their malls in the north. So FCT, we are forecasting a 5.5% yield, as well as a target price, maintaining our buy call and a target price of $2.79. Next, moving on to Keppel DC. Okay, so for Keppel DC, they're a pure play data center owner, and as we know, data centers are a resilient, future-ready, and an essential asset class. So even in the height of the pandemic, the data center operators and the personnel were considered essential workers and able to continue going back to the workplace to carry out their operations. So if you look at the graph, the pie charts on the left-hand side, first of all, we see that Singapore is their dominant market, accounting for 58% of the revenue for FY21. And also by lease type, we see that the co-location leases account for about 71% of the MPI. So most of their leases in Singapore are actually of the co-location type. So co-location actually allows the data center operator or owner to charge a higher rent because they are not only providing the space, they are also fully fitting out the space with your cooling towers and your machinery and equipment, as well as they're also providing some services which are like redundancy services. Yeah. Power redundancy services. So therefore, all in, because of these adding services, they are able to charge a higher rent for the co-location asset leases. So in Singapore, as we know, the data center moratorium is still in place, and of course, we think that in the long run that will lead to a demand-supply gap for Singapore, and that will help to push up the market rents. So the co-location leases are also on a more shorter lease term. The leases in Singapore are going to expire within 1.2 years to 1.8 years, and that will coincide nicely with the appreciation in market rents. Keppel DC is also very active in unlocking value across their existing portfolio. So in the last 2 years, we saw that they have actually done a lot of AEIs, and some of the AEIs that were done at Keppel DC 1, Keppel DC 2, Keppel DC 5, as well as DC 1 and Dublin 1 and 2. So what are some of the AEIs that were done? For example, they will convert non-data center space to data center halls, and that allows them to, of course, charge a higher rent for the data center space, as well as bring on additional power onto their assets, so that they can then, actually utilize the space and rent it out to other tenants. Yeah, and most of these AEIs are actually done on a pre-committed basis. So before Keppel DC actually even puts down some capital outlay for the AEIs, they already know that they have a tenant that is going to come in and take over the space. Yeah, so that of course reduces the risk for Keppel DC in general. Lastly, Keppel DC, after unlocking the value across their existing portfolio, the only way to grow is through inorganic growth and acquisitions. However, due to the increased competition for data center assets, there has been a little bit of difficulty for Keppel DC to actually acquire, and hence earlier this year they actually proposed an expansion of mandate, and this might accelerate the inorganic growth for Keppel DC. So what the management shared with us was that some of the portfolios that were put on the market, they also include data center assets as well as some infrastructure assets like your telephone towers and your subsea cables. And because Keppel DC has a very narrow mandate of only allowing them to acquire data center assets, this sort of hindered their acquisition momentum in FY20. So moving forward, this expansion of mandate will help to accelerate the inorganic growth. They can always acquire a portfolio of assets and then divest the non data center component, or hold it as just to collect pure rent and not to take on any operational risk. So we are maintaining our target price of $3.20, and we are forecasting a FY21 DPU yield of 4%. That brings us to my last counter, which is Manulife. So for Manulife, they are US office REIT. They have a defensive portfolio, and their WALE is about 5.3 years. And this is because the WALE, the US tenants in the US, they usually sign for a longer lease term of 5-10 years, versus the Singapore kind of tenants, where they usually sign an average of 3 years. Okay, so they have a very long WALE of 5.3 years, and 96% of their leases actually contain a rental escalation clause. So on average, that's about 2% per annum. And they managed to maintain occupancy of 92%, which remains above the average occupancy of the US office market. So in terms of subleasing, their assets are also outperforming the market. So what subleasing is basically when you rent to tenant A, but tenant A decides that they no longer need the space or need less space. So then tenant A can then put the space on the market to lease to another tenant, tenant B or tenant C. So this space actually, this subleased space actually competes with the building's existing vacancies, and that might actually cause additional supply to the market. Yeah. So in terms of the markets where Manulife has a presence in, if you look at the graph on the left-hand side, then you see that the average subleasing in the cities where Manulife has a presence in is about 11%. And so Manulife's own assets, their subleasing is at about 3.3%. So that's even below the market subleasing, and this of course is way below the subleasing in some of the notable gateways of San Francisco, Seattle, and New York, where subleasing is at about 30%. Okay. Last of all is the resilience of office using tenants, and they have actually managed to maintain a high collection rate of 99% in FY20. So some of the office tenants that are within Manulife's portfolio, they are mostly 22% of them are actually finance tenants, and then after a portion of it is legal tenants. So they were less impacted throughout the pandemic. However, we are actually reprioritizing the order of our calls. So now we are in favor of prime, and this is because as we mentioned, Manulife has a portfolio of the tenants are largely financial and legal kind of tenants, and whereas the tenants which are the future economy tenants and able to command a better rental growth, those are the tech tenants, your life science tenants, biomedical, as well as your media and science tenants, and because Manulife's portfolio lacks exposure to these new economy sectors, and the rental growth will be less compelling moving forward. And this is also explains why Manulife is also pivoting their strategy and trying to acquire some assets located in cities preferred by the tech, life sciences, and healthcare tenants. So I'll now pass on the time to Jie Hui. Sorry, that's it, right? Manulife still offers a good yield of about 7.5%. So I'll pass on to Jie Hui to elaborate more about prime.
Okay, thanks, Nat. Okay, next we have Prime US REIT. So Prime US REIT is also a US office REIT. Now going straight into its investment merits, apart from the portfolio's diversification across assets, geographies, and industries, if you can refer to the chart on your left, we like that there's a greater emphasis on the established trade sectors like your finance and legal, as well as growing trade sectors like science, tech, and communications, because these are either your incumbent office users or sectors in an expansionary mode. So in our view, actually this makes the portfolio more resilient. Just to share more color as well, during COVID-19, rental collection rates have been high at 99%. Prime also has a long WALE and a higher than average Class A occupancy. So with minimal expiries coming up, Prime's income stream is expected to be stable. We also like that we can expect stronger rental growth for the portfolio. So Prime's portfolio has almost all of its leases equipped with built-in rental escalation of 2%. Additionally, portfolio in-place rents are currently below asking rents by 6.5%. In other words, it's likely that we'll be able to see positive rent reversions going forward as leases expire, given that new rents are likely marked closer to market. Lastly, its recent acquisition introduces 2 new assets in 2 new markets. So this will increase Prime's AUM by 15%, and it will provide more exposure to key industry sectors like medical and biotech, as well as increased diversification. So no single market now will contribute more than 12% to the portfolio. Apart from that, the new assets acquired actually has a higher occupancy and WALE as compared to the current portfolio. So all in, we are positive about Prime's recent development. And just to wrap things up together with Manulife, we are still positive about the US sector, given that more citizens are getting vaccinated and also companies are getting their employees to return to office. So the key dates to look forward to includes the 4th of July and the 1st of September, given that is when schools have announced their reopening and more companies have announced their return to office. So our call for Prime is to accumulate with a target price of 94 cents. The yield is about 8.7%. Next, please. Yeah, so in our next slide, we have First Sponsor. First Sponsor is a developer, owner, and financier of property projects. Its main operations are in China and Europe, and this company is supported by two key stakeholders, namely Taita and CDL, both of which are recognized property holding companies in Asia. We like that First Sponsor is getting multiple streams of revenue from its development business, and this is through its complementary business lines. So starting with the property development business, the main thing to note is that the Greater Bay Area, specifically Dongguan, which is the key market that First Sponsor operates in, actually saw high demand for its properties such that most of its residential projects tend to sell out shortly after launch. Interested buyers were paying money just to queue up for a chance to buy the properties. As such, it owns more than 600 million worth of revenue that has yet to be recognized, and its existing projects provide for a gross development value of close to 3.2 billion, which is worth almost 10 years of sale. We also like the high recurring income coming from the property financing business. So if you can look at your chart on your left, we're expecting a 18% growth in loan book and revenue for the year. This double-digit growth in loan book is due to the buoyant development sector and the tightening credit market in China. So just to give you some color as well, banks in China are selective. They tend to lend to state firms and larger listed private companies, and they usually lend on development and not land itself. So as First Sponsor is also a property developer, the group can provide securitized lending for land purchases. First Sponsor can also negotiate for an equity deal that conjoins both property financing and property development, which gives First Sponsor more opportunities in both fields. So now moving to property holdings. Office is stable. In our latest update with First Sponsor, we understand that First Sponsor's hotels in both China and Europe are recovering well. So life is almost back to normal in China. People are going around with no mask, people are hosting weddings, etc. Europe has also recently eased its COVID-19 measures, especially in the month of June. First Sponsor is actually seeing pent-up demand for domestic tourism. A number of hotels saw occupancy recovering to 60+% from 10 to 20% occupancy a month ago. So with this final engine of First Sponsor turning around, we continue to be positive on First Sponsor. Our rating for First Sponsor is a buy with a target price of $1.56. In our next slide, we have Pan United. Next, please. Pan United is the largest provider of ready-mix concrete and cement in Singapore. It's a market leader with almost 40% market share. So the main story for Pan U is that we are expecting a recovery in construction demand in Singapore. If you can look at the construction demand chart on your left, we are buying at almost the bottom of the cycle. We are expecting 2021 construction demand to improve by as much as 31%, and this will be led by public residential and civil engineering projects. This includes projects like Jurong and Cross Island MRT lines. Further ahead, we should see a steady improvement from 2021 levels, boosted by more public sector projects. So we are expecting Pan U to benefit from this given the high market share. Next, we believe that there are high trade barriers to entry. So apart from having dominant players in the market, silo facilities are limited due to land constraints, and due to environmental reasons, batching plants have also gone up in prices in recent years. Pan United has its own cement silos as well as stack producers and RMC batching plants. We like that Pan U is invested in almost every part of its raw material supply chain and obtains most of its imported materials, which is mainly cement, from strategic partners, and this makes the upstream supply chain more resilient. So now moving downstream, Pan U owns or manages virtually all the components and processes across the concrete value chain, from innovation and production of concrete to the delivery to customers. So just to give you some context as well, concrete products should reach customers within 2 hours of delivery. So an efficient downstream system is actually very important. Pan U uses their in-house technologies like AIR, which is their concrete management platform, and GoTruck, their truck hailing platform, to streamline day-to-day operations and transport materials without owning a single truck. So all in, we believe that these innovations will continue to give PenU its competitive edge. So now to conclude, I'll call for PenU is a buy with target price of 40 cents. Yeah, this is all for PenU. I'll pass my time on to Vivian for LHN.
Thanks, dear Hui, and good morning, everyone. So I will be moving on to LHN. LHN is a real estate management group, and we like this counter mainly for its two subsegments, industrial and residential properties, which are under its business segment called space optimization, and that explains the title for LHN. So firstly, for the industrial properties, they have this work plus store outlets, which are 70% occupied by e-commerce tenants, and they enjoy high occupancy levels of 90%. So for e-commerce tenants, work plus store outlets could be said to be the most viable and affordable solution if they want to expand, because most of them started from home-based business, then they want to expand out and set up and basically have a place to store their goods and also do some work, which work plus store also offers. Otherwise, they have to like rent a retail storefront or actually rent the industrial spaces. But for work plus store, they have fully furnished. They are fully furnished, and also utilities and everything is involved, is included. Yeah. And if you refer to the graph on your left, you can see that the online retail sales as a proportion of total retail sales, as represented by the red line, is it spiked in May 2020 during the circuit breaker. Then it came down in the rest of the 2021, but it is still substantially above pre-COVID levels. So the dark blue bars are representing the absolute value of the online sales. So if you refer to the second bullet point on your right, you can see that year to date, May 2021, the absolute value of the online retail sales was up 21% to almost $1.9 billion. And as for the share or the proportion, it almost tripled from pre-COVID levels of 6% in January 2020 to 16%, which was recorded in 2021. LHN is also looking for properties and assessing them, their suitability to acquire and transform into work plus store spaces. So moving on to the residential properties, they have this Collywood portfolio, which are co-living spaces. So for Collywood, they offer flexible lease terms with a minimum of 7 days stay and affordable rents of a range between 1.5 to 2.6K per month, depending on location and room type. So for Collywood, the occupancy is almost full, and we are expecting 4 projects to commence operations over FY22 and 23. And recently, in an announcement regarding the acquisition of the Amber property, which is also among the 4 projects to commence operations, LHN mentioned that they are aggressively looking to acquire properties for its Collywood portfolio. So that said, we are expecting more projects to be announced over the next year or so. Currently under operations, they have 5 buildings and 810 keys under the Collywood portfolio. So in conclusion, we believe that LHN will continue to be an optimizer of real estate trends as the demand for serviced residences and e-commerce continue to rise. We have a buy rating with a target price of 54 cents. So that's all for LHN. I will now be passing the time on to Terence for DBS Group.
Yeah, thanks, Vivian. DBS is our top pick in the banking sector. For first quarter of 2021, we can see the earnings actually beat our first quarter earnings estimates by 34.5%. Let me rephrase. Their earnings came in at 34.5% of our first quarter 21 earnings, which beat our estimates. So there are really 2 reasons why they beat our earnings estimate. Firstly, we saw a GP reversal in the first quarter of 2021, and we also saw the NIMs and the NIMs and the net interest income actually stabilized in the first quarter of 2021. So for the full year 2021 earnings, we expect earnings of $6.1 billion, and we expect the second quarter upcoming earnings and the second half 2021 earnings to actually see further GP reversal that they made, especially because they made significant provisions in FY 2020. In terms of outlook, we continue to see NIM stabilizing. The loans growth we also expect to recover to about 5% for the full year of 2021. Credit costs will also stabilize, and like what we mentioned, we see further GP reversion for the whole of 2021 and 2022 as well. In terms of near-term catalysts, we see the dividend cap removal as a positive catalyst. This is currently under review by MAS, and we expect an announcement soon. The special dividend is expected after the removal of the dividend cap. We maintain our accumulate rating with a unchanged target price of $31.40. For our next company that we cover is Keppel Corp. Next slide. Yeah, thanks. So for Keppel Corp, we see two main announcements, two main drivers for them. Firstly, they signed two non-binding MOUs to exit the O&M segment. So if you look here at the chart here, sorry, let's give me a walk. Yeah, sorry, just let me continue. For O&M, the O&M segment, Keppel O&M has signed a non-binding MOU to actually merge their Keppel O&M, the operating co, with Sembcorp Marine. So if you look here at the chart on your left-hand side, you can see that in the beginning of the year, Keppel O&M actually split their business into three main segments: operating co, REIT co, and development co. So we provided a summary of what these three business units are below. We'll just read them out. So for operating co, what they do is they develop and integrate offshore energy and infrastructure assets, whereas REIT co is to put completed rigs to work or to sell them. So these are some of their existing rigs that they have already finished building, but they cannot sell them. So they expect, in the beginning of the year, what they say is they expect this to be divested along with development co. So development co or dev co is to complete the rigs currently under construction. So in this latest MOU that that Keppel Corp have signed with Kyanite Investment Holdings, a wholly owned subsidiary of Temasek, what they are going to do is they're going to combine and merge REIT co and development co, these two entities here, into one single entity called Asset Co. So again, you can see in this chart here on the left hand side, you can see these two entities will now form Asset Co. So Asset Co has a valuation of about $3.9 billion of assets and receivables. So Kyanite Investment Holdings will source and procure 80% of investors to take up this $3.9 billion. At the end of the whole entire exercise, it is expected that Keppel O&M will hold about just 20% or less of Asset Co. Whereas operating co is currently under negotiation with Sembcorp Marine to merge both entities. So we see the entire exercise, if both exercises take place, will transition Keppel away from the O&M business into an asset-like business with a target 15% ROE for the group, which is respectable. So we maintain our buy rating on the group with a higher target price of $6.20 from $6.12. So that's all from me for Keppel. I'll now hand over the time to Paul to wrap up the rest of the stocks. Paul, over to you.
Thanks, Terence. So Asian PayTV, I know some of you probably heard this multiple times because we included this in almost a year ago. I think the rationale was purely just to clip the coupons, which is the 8 to 9% yield, and then just wait for the 5G to roll out. So that's basically the whole game plan for this. The 5G has been slower than we expected. Okay, and just to go through the points, Asian PayTV actually they are the monopoly cable TV providers. So these places do not have fiber, and not like what we have in Singapore, and they rely a lot on fiber. But of course, what happens is everything is fibered up to almost to the homes, and from the homes is cable. The other thing is we like it is just that the subscribers is stable because broadband is growing, and I think they get additional lift when you have the pandemic right now, since everyone is working and being entertained at home. The main thesis is that the dividends, the 1 cent that they're paying on a quarter, 1 cent for the year, and this is like 0.25 cents paid quarterly. So this is sustainable because it's 18 million compared to their free cash flow of 65. Our free cash flow takes into account interest. It's not the fake EBITDA, so-called kind of definition of cash flow. The other thing that the fourth bullet point is that the timing of 5G is uncertain, I think, but the end 2024 is the hard deadline, because by then they're looking for population. I think the authorities looking for at least 80-90% coverage. That is the hard deadline. I think, but the telco should do it earlier. So that is the timeline that we have. So no change in our target price or buy recommendation. Next slide. So for Comfort DelGro, essentially the thesis is that we are betting on the rebound for domestic recovery, domestic reopening. Not so much international. I think international transport, the way the pandemic is I guess flourishing in the regional countries, probably international borders reopening will take some time. But this is more of a domestic reopening because Comfort DelGro share price is down 30% from the pre-pandemic. So the first bullet point, we just want to emphasize, as per the chart below, even though the pandemic was here and they made losses, the balance sheet actually improved. So the net cash of the company actually rose to, I guess, a 4-year high. But there is a near-term dampener. I think the second quarter has been hurt by the pandemic, and also as a result, they had to increase the rebates to taxis. Real volumes also dropped quarter on quarter, but year on year is up. I mean, I think 2 times. I think looking at the data. The next driver, which is unknown, I mean, I have no idea when this happened, but there is a possibility and it should eventually happen, is the real financing framework. I think this is just a very fancy word, but I guess the key thing is that the ridership risks will be on the government authorities and not on the Comfort itself. So right now, if there are no passengers, because right now the way it's done for Comfort or SBS Transit's rail is that if there are no passengers, then you bear the risk. But the other models, like SMRT, is that the authorities pay you a fee. So if there's no passenger, the risk is not borne on Comfort. So you don't really care if there's anyone. You just make sure the rail runs, or running in circles, even if it's empty. UK and Australia profitability should recover as the reopening happens. Of course, but because in Australia, what happens is that they are paid a schedule. So even similar to Singapore, you're paid a fee regardless if they are passengers. So they don't take passenger risk. But we are not, the final bullet point, I think we are under no illusions. I think we know Grab is still a very formidable competitor. And that will remain the overhang for them. But ours is more of a reopening place. So that's the reason why we have Comfort DelGro. Next slide. Our final one is Q&M Dental. The main thing is, for us, the most sustainable part will be the rebound will be the growth in dental clinics. As you can see from the chart, in 2013 to 2016, they hardly grew clinics, maybe 5 to 8, but because they were mainly on acquisition and they were focused on China. But this has changed. I think they realized that even though they are the biggest, they only have 10% market share. So they're going to ramp up clinics, especially in Singapore. So that will help and create a sustainable growth platform for them. So the third bullet point is just that we've already seen the big bounce in revenue. I think 47%, PATMI up 3%. And that's also because with everyone stuck at home, and also dentists also stuck at home. So capacity is, ability to do surgeries is up because dentists are here. And also more and more people are going to clinics. And also the work from home does affect dental hygiene. I mean, you have to ask the dentist for that. But what we're saying is that, and also in general, medical services have shifted. I think it's not only you go medical service right now for essential purpose. I mean, if you're sick or you have tooth issues, right now people go to for medical services for aesthetics. So there's another element to medical, not just for dental. I think you see it in aesthetics and other, because with masks, people are taking the opportunity to have more braces on and so forth. The next one is a PCR test. So that will give, we think, a 30% lift for at least the next 1 to 2 years to earnings, as testing remains a key strategy to handle the pandemic. So we have a buy and a $1 target price. Next slide. Okay, so we're just going to conclude. If you saw the title of the report, it was vax and relax. So you know, in the US, vax and relax means you vaccinate, I give you free haircut, but that's not what we are referring to. What we're referring to is that a year ago, 12 months ago, we were not even sure there was a vaccine. 6 months ago, we only started vaccination in Singapore. But right now, the situation is different. At least we have some opportunity for normalcy. At least we have some visibility as we hit herd immunity, hopefully in October. So the key point is that unlike 6 months ago, no vaccination is underway, and especially in Singapore, it's accelerated. The second thing is that we are trying to position for aggressive reopening and to cater for domestic business. I think international will still be an issue. I think what you see like in US, in Europe, domestic is coming back with a vengeance, but I think not so much for international. The third bullet point is that the macro conditions continue to be conducive. I think interest rates will remain low. There is even a slight possibility that rates may not even rise in 2023 as what the dot plot says. I think if we enter 2023, that means next year, and economic conditions slow, the Fed may not even wish to raise rates. I think because things are actually worsen next year. Again, we're not clear. I mean, that's a big unknown. But if that happens, then the low interest rates will remain. And if you recall, the last time the Fed raised rates, it took them 7 years. So historically, it usually takes some time. But again, right now, of course, the base case is still late 2023. Our STR target, just for reference, is 3.4. It's about 16 times PE, slightly higher than the 14 times historical average. Okay, I think that's it. I think we can take questions. Thank you everyone for dialing in, and especially for all your questions. We will try to address as many as we can. As you know, this is our WhatsApp channel. We will eventually move it on to WeChat, but for now we have this. And if you, for all the LISCO webinar, I think you can just dial in to the website at the bottom under poems. So thank you. Let's go on to the questions, and turn on the video if you can. Yeah.
Hi. Okay, I think some of the questions are for me. I'll start off first. The first question is, why do you think Ascendas price does not seem to move up? Resistance seems to be at a $3 level, whereas MIT has moved up a lot. I'll speak from a fundamental point of view. I think that one of the things that has been, Ascendas has been tapping the market quite frequently for new private placements or preferential offerings, and I think that seems to have an impact because as a lot of these unit holders, they actually do subscribe for the preferential offering and all that, and after they need to they want to rebalance their portfolio to reduce the exposure or to have a more balanced exposure or what have you. So I think that also does have a little bit of impact when they rebalance and they sell off some of their positions. But overall, because Ascendas is the largest industrial REIT, definitely the frequency at which they acquire, as well as have to tap the market for additional fundraising, would definitely be higher than the likes of your smaller REITs. Yeah. Another thing about Mapletree Industrial Trust is that this year itself there was a catalyst for MIT where they acquired another portfolio of data centers. So I guess it's not really the portfolio was very much larger than the Ascendas data center portfolio. Yeah. Overall, in terms of your asset class allocation, Mapletree has about 30% in data centers, whereas Ascendas has about 10%. So that could also be a factor for why the stock seems to be more in favor due to a larger proportion of the new economy asset class. Okay, I think nonetheless, just want to wrap things up by saying that overall, we do like Ascendas still. We prefer it, and I think it's because of overall their portfolio does seem more diversified and resilient. Okay, so next question is, what's your take on CDR Hospitality Trust given the worsening COVID situation and the group's issue with the China investment? I think the China investment has less of an impact to CDR Hospitality Trust. Overall, we are expecting a quarter-on-quarter operational improvement for the hospitality trusts in general. It's not going to be very until the border opens. The impact, I mean, the recovery for hospitality is going to be more muted. But as more economies actually aggressively roll out their vaccination programs, then I think, you know, we can expect like a stronger recovery. Yeah, but overall the hospitality sector does face a longer timeline for recovery. You know, many sources, including the Singapore Tourism Board, is actually forecasting a 4-year kind of recovery time frame. Yeah. Okay, so then after that, there's another question here about city development. Please, can you please comment on city development? Okay, so for city development, there was a recent update, 5th July, where they actually announced that there was a bankruptcy claim filed by this Beijing Yihe Mercury Investment Company against Sincere. So for Sincere, CDL has already sort of recognized 1.7 billion in impairments for their investment in Sincere. So what actually remains on their balance sheet with regard to Sincere is some of the financial assets, which means like the debt that CDL has extended to Sincere. Yeah, and that is about $126 million of exposure to Sincere. Yeah. So I think more or less the exposure to Sincere has already been written off. So that was reflected in the price adjustment that we saw last year, FY20. Okay. So I think moving forward, what CDL will try to do with regard to Sincere would be to try to acquire, you know, if there are any other portfolios, assets that are of good quality, they can of course acquire that, and basically using whatever knowledge they have of the assets that they have acquired in 2020, yeah, and to evaluate the quality and strength of the asset for acquisition. Yeah, I think not so much. They also like reiterated time and time again that they will not be, you know, issuing any debt for Sincere. So I guess the keyword here is ring fenced. Their investment in CDL has been ring fenced. Yeah. Okay, I just want to jump in for CapitaLand. The question here is, CapitaLand is to be listed. Will the recent developments, divested assets and re-rating, etc. affect the deal at all? Okay, so for CapitaLand, they will be delisted. So CapitaLand will be split into 2 different entities. The development arm is CapitaLand Development, CapitaLand Development will be privatized, so that will own that part of the business will own your residential development and some of the other developments, the portfolio of developments, as well as some of the unmatured or yet to be stabilized assets, those that are not ready to be injected into the REITs or not ready to be sold off because they are still stabilizing and they're still ramping up their operations. Yeah, so that will be the CDL Development will be holding the development assets as well as the mature asset platform and the fee-based platform. So those will hold the stake of the REITs as well as the management, the fund management, real estate management capabilities for the REITs and the private funds. Yeah, okay. So that is just a recap of the deal. And how will the recent developments and divestments affect the re-rating? Okay, so because some of the recent divestments actually came from, for example, your 2 Japanese malls for $500 million. Those assets are actually the more developed, mature assets. So any gains that are reported will actually flow to the CLIM clean balance sheet. Yeah, and then it will be shared. So how these actually affect it will affect the price of CLIM. So right now there's no CLIM, right? It's not listed. So theoretically, what we can do is we can forecast the value of CapitaLand Investment Management CLIM, and that right now will be reflected in the share price of CapitaLand. Yeah. So of course, if they are able to conduct even more value enhancing kind of divestments and all, it will all be aggregated on the CLIM balance sheet, and it will flow back to CapitaLand for now. So of course, when it's separated, then CLIM will take on its own valuation, and it, in a sense, it will not affect the deal offer. The purchase offering, the offering is for $4.10. It will not change based on the deal, I believe. And we also need to wait for more information that will be released to the public. The documents will come out sometime in the third quarter of 2021. Yeah. Okay. There's another question here regarding Ascendas. Is Ascendas planning for any acquisition for the next 6 months until December 2021? Currently, we haven't heard anything. And with these kind of public listed companies, they actually try not to disseminate information that is non-public in nature. So as of now, we don't have anything else. Initially, I think the Ascendas wanted to achieve a 40-60 split between overseas and Singapore assets. So I think right now we are pretty much there, 40-60 split. Any more acquisitions could likely come from Singapore, the Singapore side of things. And if they were to acquire overseas, then the key markets that they will be looking at are those that they are already in, which is your Australia, US, and UK. Yeah, so that's what we have. Sorry, I'll now pass the time on to Paul. Yeah, for some questions.
Jahi, can you take some of the questions? Then we'll go to Weiren.
Okay, hang on.
Okay, as we wait for Jahi, let me just try to answer the Del Monte one. So what are the major risks in investing in it? The main thing is the balance sheet. I think as we mentioned, they've got like 100 million interest expense, and if the turnaround doesn't happen, then obviously there'll be balance sheet pressure. But on the flip side, if the turnaround does happen, then you get another kicker to earnings because the interest expense will continue to wind down. The interest expense came from the acquisition of Del Monte US, which they acquired for 1.7 billion. So it's almost like they acquired their whole market cap and bought another company with even larger market cap. So with that, and that was all debt. So it took them some time to try to turn it around and also wind down the debt. But for me, I thought if the turnaround does happen, then you get a double benefit from the lower interest expense, which will help the earnings. Okay, Jerry, I'll hand it over to you. Thanks.
Okay, I see a couple of questions for me. So, okay, I'll start with the PenU question then. The question is, how do you see the threat from government promotions of PPVC as a way of construction, and can it mediate the risk of a shrinking pie? Okay, so rightly pointed out, I think maybe just some background. PPVC is a possible substitute for ready-mix concrete. It's actually a method where concrete blocks are molded, are pre-molded off-site before they are installed on site. So as pointed out as well, PPVC actually has some benefits that concrete doesn't have, which includes earlier delivery and I think maybe fewer transportation trips. But as of date, from what I understand is that this mode of construction cannot be applied to every civil engineering projects due to size constraints and also transportation difficulties. So, and then I think not to mention a precast concrete plant is also very costly due to machinery. So there actually isn't a lot of plants out there. So I think according to BCA also, the demand for PVVC is actually expected to be around 1 million in terms of cubic meters, while RMC demand is actually much more at 11 million. So if you can tell, actually the demand for RMC is still there. So I do believe that in the near term, PenU will still be able to hold as in this advantage of theirs, in a way. So hang on. Okay, I see another question on IREIT Global. So the question is, the non-renounceable rights issue, today is the last offer. So is it worth applying? Okay. Also just some background. The rights issue is actually part of their equity fundraising to raise equity for their new portfolio of 27 funds, Decathlon assets. So these assets, this acquisition is expected to increase their asset base by 16%, increase diversification, as well as introduce Decathlon as a stronghold tenant into its tenant base. So actually, our overall view for IREIT is that it's still positive. It's a stable European REIT that is anchored by strong tenants. And during COVID-19, actually, there hasn't been any rent deferrals or rebates granted. Post-acquisition, we believe that there's still room for further growth, given that the gearing levels are still at 36%. So actually right now, right, IREIT is trading close to the theoretical ex-rights price of, I think, around 63 cents. Yeah, so applying for the rights issue at 59.5 cents still provides for 6% discount and will prevent stake dilution. Then I see another question on HRNet. So HRNet, currently we do not have any coverage, so we won't be saying too much about it. But just to give you some color, HRNet is actually the largest recruitment agency in Asia, ex-Japan, and is currently the largest player in Singapore. It's currently the largest player in Singapore. So Singapore is actually their stronghold that contributes more than 50% to their gross profit. And with the turnaround in economic growth, not just in Singapore, but throughout Asia, we believe that it's likely that HRNet will be able to see increasing contract volumes for their human resource business going forward. Then there's another question on first sponsor. So first sponsor, okay, I'll just read out the question. Is it wise to buy into first sponsor group and any REITs associated with the troubled CDR group where governance is an issue? So CDR is one of the key investors of first sponsor, but that doesn't affect the merits of first sponsor. So as mentioned earlier, we do like that first sponsor is actually seeing multiple streams of revenue from its property development business. And I think I also mentioned the merits of first sponsor earlier. So maybe just to summarize, we actually really like the property development business because the Tonga market is actually very, very hot, and people are actually, as in their projects actually sell out very, very shortly after launch. Then interested buyers will also paying money just to queue up for a chance to buy the properties. Then they also have two other business lines which are actually complementary to this business lines. So I think as in we should just view first sponsor and CDL separately.
Yeah, just a reminder, first sponsor has been around since 2007, so they're not a new company, number one. And what they do is they work with a lot of partners, like they work with China Poly, a state-owned company. They work with China Railway, which is obviously a state-owned the large railway corp. So maybe one difference, I know we don't really follow CDL, but one difference is that they do work with a lot of local partners, and rather than maybe go at it alone. So that is one differentiating, and also they've been around for many years. Yeah, and they've really been in China for many, many years. Yeah. And it's not only CDL, there's another partner which is maybe just as large, Taitak. As you know, it's the major one of the big shareholders in UOP. Okay. Ren, you want to there's a SPH question, so I'm not sure is it technical or what, but I'll just move on to the technical part.
Okay, sure. I'll do some technical. So I've just mocked up the questions for this. So just will share this. So yeah, if you can see my screen, let me know. Is it a right screen? Now I'm on Del Monte. So just raise up your hand if you can see my screen. Yeah, okay, cool. All right, so okay, I'll do Del Monte first. There's some interest. I think Michelle asked for why it tanked. Actually, it's much more of I already mentioned that there is a potential bullish flag based on my recording, but based on the sharing I shared on the strategy and stock pick itself and just earlier on just now on why I think Del Monte is a good buy, but just wait for some correction. Probably around at the 36 cents to 32 cents region. All right. Okay, so I'll move on to Ascendas. So someone asked about Ascendas, what caused the slow-mo compared to Maple Tree, all this. All I can say that today it did break off the resistance, not a very strong one as compared to CapitaLand. CapitaLand also exhibit a same kind of a price movement today. All right. And then you look at that for Ascendas, I think price still is not out of the bearish trend yet of this ascending channel. So likely you want to confirm it, you need to break resistance zone to confirm on the upside. All right, so I think someone asked about city development. So city development, there's a morning star which I shared in my Telegram group early last week, on Saturday itself actually. So today there is some of bearish covering of the gap. So it's like more of like if it breaks the $6.58, then likely it's going to continue on the downside, right, for CDL. All right, for Silver Lake, last Friday was spectacular rise, breaks off the falling wedge, but today bearish candle is going to come down to test. So not sure on how is it, but all I can say that is nearing the 30 cents psychological resistance level. Therefore, we could see some of a price coming downward on this. All right. Okay, I'll move on to the Hong Kong stock. For the Hong Kong Housing Tech Index, the iShare, our price did rebound from the support zone, so likely it's going to go up. Okay, the inverted head and shoulder has failed, so I'm going to take out this. Price is likely to come to rebound slightly higher. So expect some sort of consolidation over here before it carry on the upside. Bullish hammer at $15 and $14.68 support zone is likely to be proven to be strong. Okay, so let's look out for iShare. Okay, so for Alibaba, as a bit the same price, like the iShare, the Hang Seng Tech Index, the 3067. Okay, so bullish hammer in the support zone, but the bearish downside, it make me a bit uncomfortable. So it might go down lower to test $18.41 before it actually has a very, very strong actual rebound thereafter. All right. Ping An slightly to support zone is likely to break further because the rebound is not very strong over here, honestly. All right, I think it's going to break down lower to test the support zone lower at 62 to 65.05. All right, that's for Ping An. So for Hong Kong Stock Exchange, inverted head and shoulder was considered with failed after it breaks off this resistance zone at 490 to 501.8. However, I think suggesting that multiple testing is likely to weaken this resistance zone. So mid-term to long-term target, I'm seeing 543 to 566.8. But expect some form of correction down to 470 to 463.4 before embarking on a buy to target on the upside. China Software, I'm still bearish on it. First of all, it's the consolidation. The high wave candle on 6th of July, which is last Tuesday to be exact, was kind of like indicating some sort of neutral confusion stage. But what gives way is the bearish divergence at the rising wedge. So now you can see that there are some sort of like multiple high wave candle. It means that the market for China, the momentum for China Software is likely to be running low. The momentum running low, and therefore there's a chance for a breakdown of the falling wedge. So just look out for it. Next one will be ComfortDelGro, still ranging tightly, so not much comment for ComfortDelGro. Like what Paul mentioned, that ComfortDelGro mostly are on the opening play, reopening of the economy, and then back to normalization. But however, I think Grab is still a formidable opponent, and then based on what the technical is showing, price is if it's going to break 1.68, I think 1.80 to 1.76 resistance zone is likely to be the next powerful resistance that will cause a sell down eventually. If it breaks, then long term 2.11 to 2.19, yes, you may target well, but if you look at the whole lead chart, we are perpetually on a very strong downtrend right now. Okay. In fact, this is like much more corrective right now. If we going to enlarge it, it will be much like a weekly bearish flag going forward. Okay. So lastly will be OCBC. Same like SDI this morning. It opened up with a gap, piercing line, but bearish cover. So bearish candle that fills up the opening gap. So the question now begins: will we see a lower low? Answer is I'm quite confused right now. But for banks, I think I favor towards a rebound, a correction to the downside before a rebound. All right, any rebound, any immediate threat need to clear above $12.31 for OCBC in order to gain some probability and a chance to get into the bullish rebound zone. All right, so let me see if there's any more CapitaLand I have shared. Okay, so Bank of China, and then I will do. Okay, the last one I will do.
Yeah.
Sorry.
The MM2 one, I think it's a MM2 technical. Then I'll just go on with the fundamental part.
Okay, so
thanks.
I'll do Bank of China, Gili Auto, then I'll do MM2, and then you can take over. So give me a moment. So Bank of China is Bank of China is 398. Yes. Bank of China is strong gap down, rebound. So likely right now, I'll see further some sort of slowing down momentum. Despite there is a bullish divergence right here, price remain weak, upside rebound today. Okay. Okay, so I'll do Bank of China and then Geely, and then I'll do MM2. So for Geely Auto, the rebound and then the correction. So right now, the resistance and support is kind of well supported here, but it's like consolidation. So price can either go either way. Okay, so yeah, yes, so it's kind of like can go either way, or you can target resistance zone or go back to support zone one before going back on the upside again. All right, so the last technical I'll do MM2 Asia. So MM2 rebounded, but let's see, there's this last week there's this dark cloud cover that's like formed by a Harami, but today the price seems not to be moving that well. Immediate resistance zone 0.9098 to 0.103 remains. All right, so this is for MM2 Asia. So without further ado, I pass my time to Paul, back to Paul. Thank you.
Thanks, Viren. I'll just answer 2 or 3 questions, then we go to Terence, then we wrap it up with the prime question. Then I think we should more or less answer most of the questions, hopefully. Okay, let me just quickly run through. The question is, what do you think about MM2 in short and long term based on the fundamental and technical view? So we don't have coverage on MM2, but because they presented several times with us, we think it's interesting. I think because there's a macro theme and a micro. There's both. The unique thing is there's a macro theme behind it, and there's also micro reasons to buy it. So the main macro theme is, as we know, cinema has been the worst hit, likewise for concerts. So we could get this big rebound, and I think they're really in discussions, I think, to how fast to open and how aggressive to open. That's number one. So there's the macro theme. The micro reasons is, as you know, my MM2 strength is content. I wouldn't say creating content, because what they do is they take content and it's more like producing content, and they have almost like 100 million of pipeline. Of course, it takes time to seal some of these deals, but at least you have 100 million, and this is more like a record number of projects. So that's the micro reason. Another micro reason would be the, we all know cinema is going to be tough, I think, but the reopening will help. And number two, there will be the listing of the cinema business. That could give minority, again, I'm not so clear, okay, this is just almost like speculative, giving a bit of speculation here, but they will still retain majority, MM2 of the cinema, but there could be some shares given to the minority. So in a way, minority could get some free shares, but again, you're not sure the size, I'm not sure, but that could be one possibility. And the third micro is, of course, unusual. I know the concert last night wasn't the JJ Linon was based on the press. I think there was some technical hiccups, but that is also another business that could turn around. And you know, their unusual business is also quite asset-like because they don't really earn assets. It's a lot more labor intensive. Okay, so I hope that answers for the MM2. Let me just jump to the Asian PayTV question. Any possible sudden downside of Asian PayTV stock? The number one downside, I think, not only just for Asian PayTV, for probably all the stocks in the region, is that Asian PayTV is based in Taiwan. And you know what is the worst case? I think we all know, I mean, if you're in Taiwan, what's the worst case scenario? So that's the worst case. Of course, again, it's up to you to assess that part. But in terms of the business part, will be maybe the subscribers and so far will be coming off lower than expected. But for that, we've already kind of factored that in. That's the operational downside. And the second downside will be maybe the capex suddenly surge, but we don't think so. They really guided it would trend lower. So for us, when we look at Asian PayTV, we eyeball mainly on the cash flows. We don't really look at the earnings because the depreciation is so high. So for us, most important would be the cash flows. So that will be the downside. I think if the subscribers really fall off and capex suddenly surge, so that will be the two items. Then that will impact our thesis of whether they can sustain this 8 to 9% dividend yield. Let me take the last one, then we move on. On Top Glove. Top Glove keeps tanking. What do you think recovery to pre-pandemic levels before announcement? US has seized Top Gloves due to the unfair labor. What is the target price to recover? Okay, I don't have, maybe Warren might do, but I don't think we have time. But Top Glove, what has happened is that Selangor is under lockdown, so all the Top Glove factories, I think, have been shut. Because what they realize is that a glove has become another area, the pandemic is booming. Another cluster, sorry, the right word is cluster. So I think the authorities realized that even the glove factories are becoming a cluster, and a lot of those are affected. Just for your info, UG's glove is in Negeri Sembilan, so it's not affected. And apart from the 60%, Riverstone is in Ipoh, so I mean near Ipoh, but so they are not affected too. But they are affected by this rule to keep production at 60% in the near term. Okay, I hope that answers. I think we can move on to the maybe the banks and also wrap it up with the prime question. Yeah, thanks.
Oh, sorry, let me just adjust my video. Yeah, sorry for the technical issue. So I'll just run through some of the questions on the banks, and also there's one more question on Sembcorp Marine, which I'll go through later. So the first question is your target price for DBS, is your target price in dividend cap lift, special dividend, and reversal of general provision? So there are two questions here. Maybe I'll address the first one first. For us, the target price on DBS, we haven't accounted for. Our target price is based on 1.36 times FY21 book value, and we use 1.36 times because this is based on the Gordon Growth model. We don't want to be so technical here, but if you wish to clarify more, please feel free to drop me an email. But basically our target price don't account for this dividend cap lift. All this dividend cap lift and the resumption of the dividend, even the payment of special dividend, is a separate category, separate returns category. So our target price only accounts for the book value. So to answer your question more specifically, the reversal of the general provision, which we estimate will take place over 2 years, has been imputed in our second half 2021 earnings, second quarter 2021 and second half 2021 earnings for DBS. So that gives it a little bit of an uplift in terms of the book value, and so our target price was also upgraded in our last report. Okay, there's a second question here. Or what percentage of these are priced into your TP? So like I say, the reversal of the general provisions is the only one that we priced into our earnings forecast and consequently the book value. So in total, what we did in our first quarter financial year 21 report was to reverse some of these general provisions and also did an uplift in terms of some of the income that they will get from their net interest income. So in total, this is about 5.6% that we upgraded our earnings by in the first quarter of 2021. I'll go on to the next question. Target price for UOB. Our target price of UOB is unchanged. That's $28.70 now.
I accidentally deleted the. I accidentally press click on the Semcorp. So you got to go under the Semcorp. Sorry for the.
Sure, I'll go to the.
It's the second at the very bottom. The second I accidentally clicked on it.
Okay, yeah, so I'll read the question. Do you think Semcorp Marine's deeply discounted rights issue that was underwritten by Temasek and DBS will hurt the minority shareholders in the long run, also considering there is likely to be a third rights issue in the near future? So for Semcorp Marine, just to bring everybody up to speed, Semcorp Marine made an announcement this morning. What they did was to announce a profit warning on first half 2021, their first half 2021 results. So in summary, what the profit warning say is for first half 2021, due to COVID-19 related disruptions, they expect to see a loss provision that is comparable to the full year 2020 loss. So for full year 2020, they expect to realize, in summary, what they expect to see is in the first half of 2021, they expect to realize the same amount of loss that they incurred in full year 2020. So this really, in our view, highlights how dire the situation is for Semcorp Marine and why this deeply discounted rights issue, like you rightly point out, is also very necessary in this near term to help to shore up the balance sheet, because the outlook for Semcorp Marine continues to be challenging. I think it's important also to point out that the rights issue that Semcorp Marine is doing, in the latest rights issue that Semcorp Marine is doing, is not related to their merger with Keppel O&M. So internally, and I think for those who attend our webinars, what we think is there could be a possible third rights issue. Though the manner in which they do it is not something that we have studied internally yet, but there could be a third rights issue. Just to pay if the Keppel O&M and Semcorp Marine merger take place. So there could be a third rights issue because they do need to pay the Keppel Corp shareholders $500 million if the merger were to take place, subject to all the different approvals, of course. So in our view, we think this rights issue that is currently undertaken is not does not hurt minority shareholders, but it's more a necessary step. If they don't do that, then they will face more problems in the future. So they are trapped by their circumstances, so they have to do it now. Yeah, so I hope I answered your question on that. I think I'll just maybe let's scroll down just to see if there's any more questions. If there's no more, then I will hand back to Natalie on Prime. Jie Kui on Prime. Maybe there's what's a good price to buy DBS? Sorry, I think that is maybe Wei-Wen's question.
Okay, maybe I'll just take the last question on Prime. So the question is, Prime US REIT has one of the highest yields. What are the downsides? So actually, we don't have a lot of negatives for Prime. Some of the risks include office tenants downsizing, reducing their space needs. But as mentioned earlier, 70% of Prime's portfolio, as in Prime's gross rental income, actually comes from tenants in established trade sectors like your finance and legal, which are incumbent office users, as well as growing trade sectors like your science, tech, and communication, which are actually expansionary trade sectors. Additionally, lease expiries in the near term is about 8% for both FY21 and 22. And if we look at FY21 lease expiries across assets, the concentration is actually less than 1.4%. for each asset. So at least in the near term, we do believe that we can expect income stability from the REIT. Maybe a second negative would be that can be an increase in subleasing space due to job losses during the pandemic. Yeah, but from what we understand during the webinar, Prime actually said that this sublease space is actually increasing at a slower rate as expectations for office are actually evolving. So I think more companies are actually reconsidering the need for office. Yeah. So in terms of downsides, I think this will be the main two that comes to mind. Yeah, I think if there are no further questions.
Okay. Let me just try to do this one since it was very early and then everyone kind of voted on SPH. So the support levels and potential upcoming news will be positive or negative for the offloading of its business arm. We have no time for the technicals, but for the fundamentals, I think the important news is they get the deal done. Regardless whether we agree with the disposal price, I think the media would have been a big overhang. So the losses now is maybe, I'm just pulling a number, maybe 10 million, but how will we know, will it be 20 million, 30 million? Then you might end up with another, I mean, we hate to say this, but another conglomerate with a marine attached to it. So in a way, you had to do this. Again, it's debatable. Some will agree or disagree what is the valuation that was done. But by doing this, you clear a very huge uncertainty. And there's also a lot of hidden assets in SPH from the investments they made in the data centers. And also there's a kind of number of bungalows that they probably don't put mark to market. But anyway, having said that, I think we're already reaching our time limit, encroaching into Weiren's time. So on behalf of Poems and Phillip Securities Research, I think thanks everyone for all the questions. These are all very good questions. Just that we can't answer every single one of them. But thank you for them and thank you for attending our session here and hope to see you again next week. So take care everybody and thank you.